Hello and welcome. This week we've got Kelly McFadyen of Condominium Lending Group to talk about condo loans, project funding without levies. Welcome, Kelly.
Thanks so much, Thomas. Looking forward to it.
Yeah, it's a big topic. I got picked up last month with some conversation around special levies and strata fees and the differences in funding across the country. And it seemed like a really great time to reach out to you and have you tell us a little bit about the alternatives that exist. So delighted that you're here. And obviously a really important topic for everyone in and around the condo world. So why don't we dive right in?
Okay, let's jump in.
Tell us a little bit more about you and Condominium Lending Group.
Yeah, absolutely. So I'm currently one of the directors with Condominium Lending Group. We say CLG for short, because otherwise it's a bit of a handle. Right now, there's a group of us that work all the way across Canada. So I'm in Vancouver. I mainly look after BC and Alberta. And then I have colleagues who are specialized in Ontario and the Ontario legislation in the Eastern markets. And then we cross-pollinate through the prairies to make sure that we are coast to coast, with the exception of Quebec at this point, in terms of supporting all different types of stratas and condos, all ranges of sizes and ages, from coast to coast. And we are the only lender in Canada that specializes. This is all we do day in and day out. We're not brokers. We are the lender. We're a private lender, so there's no named bank here that you see. We're CLG. So we are working directly with the clients from coast to coast. We've been doing this, the team behind CLG, we've been doing this. I personally, it's been 9 years for me. The team behind CLG, it's been 20 years. And so lots of experience to understand the legislation and the nuances and how to support managers, different stakeholders, and ultimately owners in moving their projects forward.
Excellent. So in British Columbia alone, there are $2 billion of capital projects every year in strata communities, and you can extrapolate that across the country. They have some reserve funds, as we well know, but it looks from our numbers like roughly half of every year's capital expenditures in this province are funded by special levies. That's a big ask. Let's talk about projects and funding and see how this all fits together.
Absolutely. So one of the most important things that I've learned over time, over the last 9 years, is that whether or not financing is the solution, it's irrelevant to my role in the process. Sometimes, the best advice I give them is to look at other solutions. The most important thing, Thomas, is for these corporations to have their depreciation reports updated. That's what they're called in BC, reserve fund studies everywhere else in Canada, so that owners know when they're not blindsided by an estimated time frame for when the work is going to be expected, and a financial planning tool for best estimates on what those costs are going to be and roughly when they're going to take shape. So the project is the most important thing that I hone in. When I'm working with a client, I go into that conversation and say, look, guys, we're going to look at all different solutions. We're going to look at different ways to approach this. But the project is the most important thing. You have to stay on top of your capital repair cycle. So if I'm going to, kind of drop some legislation in BC, it's Section 72 under the Strata Property Act that refers to a statutory duty to repair and maintain common property. And every different province has legislation that says the same thing. Look, guys, it's actually not an option for you to just continue to vote this down and stick your head in the sand. As shareholders of a multi-million-dollar business, there's an obligation to repair and maintain your common property. So the project is always really at the heart of these conversations. And then if we drill down on that and we look at the different mechanisms for the business entity, for the corporation to complete the work, these are nonprofit entities. They're mandated to break even and have a budget that breaks even. They are supposed to be accruing funds in their reserve to pay for capital projects. But with the exception of Ontario, there's basically a lot of loopholes to get out of actually really doing that. And so the vast majority of corporations are underfunded across Canada. Even the most well-intended corporations may find themselves underfunded. The construction price index went up by 30% in 24 months. So no one saw that coming. Anyone who has an old, outdated report, those numbers are no longer accurate.
And there's a lot of those.
Yeah, and that's because they're only mandated every, depending on the province, 3 to 5 years, depending on what update needs to happen. So this is not pointing the finger at the reserve fund planners, because when they prepared that report, they were working with the data at that time. And so anyone with a historical update and with a historical report is, it's a good time, no matter what, to update that report and get those numbers back in line. We're now seeing the construction price index settle down to a more typical traditional historical level of 2 to 5%. But the damage was really done for 2 years, essentially during the pandemic, for a variety of reasons we don't need to get into. So if we go back to talking about this project, in a best case scenario, council or the board of directors can look at an upcoming project and say, okay, we have a $500,000 roof that we know we need to get done in 2026. Let's start planning for spring 2026 now. If they look in their reserve, best case scenario is they have accrued enough in the reserve to take the monies from there, pay for the project, and still have enough in the kitty for whatever else is still scheduled to be addressed into the near term. We know that that's typically not the case, especially in provinces like BC, where reserves are chronically and usually intentionally underfunded. So then we have to look at, what are the other levers that boards and councils can pull to talk to their owners about. And this is where there's some legislative nuances. So in BC, BC is the only province that has legislation where there's a council as versus a board of directors, and they can't mandate a project or a special levy. In other provinces across Canada, there's different work that happens. There's boards of directors, and they can mandate a project and an accompanying cash call to go with it, a special levy, or in Ontario, they're called special assessments. So that's really the mechanism, the more traditional mechanism. If you're underfunded, then it's typical to look at doing a special levy. And just as a brief recap, if anyone's not familiar with that term, it's essentially a cash call from the owners, whether you're referring to it as a special levy or a special assessment, where if there isn't $500,000 for that roof, then in BC, the owners have to pass a 3/4 vote to do a special levy, and then everyone contributes their share of that. Or in other provinces across Canada, the board can issue a special levy or a special assessment to collect that $500,000, fundraise from the owners that way, and pay for the work.
So for reference, special levies and special assessments can range in size dramatically based on the project and the amount of available reserve funds. So they can be from hundreds of dollars to quite literally hundreds of thousands of dollars,
yes,
depending on the project and the available funds.
Absolutely, yeah. And each of these projects is different, and the needed way to pay for them is going to be different. When you're talking building envelope work, Thomas, those are the biggest, most expensive projects. And when I say building envelope, that's when we're talking about, a complex that has aged siding and windows and balconies, and they really need to take it all off, go down to the studs, and kind of build things back out to have, for example, a rain screen assembly and maybe some more modern materials on the outside, new windows, that kind of thing. Those are right now in BC, those are easily 6 figures. Consistently, when I see the numbers on those building envelope projects, they're all 6 figures, if not encroaching on 6 figures. When you're talking about smaller capital projects, then it's less per unit, and then that there's less amount on a per door unit that the owners have to think about how they're going to come up with that share. Yeah, go ahead. Sounds like you have a question.
Oh, no, I'm just thinking about those numbers in my own head, and the fact that the analysis that we've done shows that the average condo owner in this province should be setting aside a couple $1,000s a year for levies. And you kind of extrapolate that out over a building's life, and you consider that some are new and some are old. It's a really significant number in this province, especially where adequate funding is not a requirement. It's percentage of budget that gets put into the CRF.
Right. And so the percentage of budget here in BC is a bit of like a stopgap, trying to just at least have a baseline for contributions. I would encourage stratas, if we're talking about stratas, to get a depreciation report, which is what they call reserve fund studies here in BC, and make sure that they are contributing or just have a heads up on what's coming. Often the planners will provide some different models. Here's we call it the pay-as-you-go model, right? Which is what BC leans on. Levies come up, pass a special levy. Projects come up, pass a special levy. But planners will often provide alternative 2 to 3 funding models that looks at, here's a fully funded model, here's a combination of levies and strata fees, and then here's kind of the pay-as-you-go model, which they always are careful to say, do not recommend. So, that's a way to have an idea of what's coming. And again, just to give our reserve planners some grace, it's not an engineering document. It's a financial planning tool to help owners have a bit of a heads up on what's coming. If it says there's a $500,000 roof that might be needed in 2027, is the roof going to fall off and disappear in 2027? No. Is the project going to cost $500,000? Maybe. It might be more, it might be less, right? These planners are using data to try and help corporations plan ahead for the future. So where I'm going with that is, your data points of a couple $1,000s a year are probably falling quite short for where the reality is going to land with owners in BC, depending on the size and scale of work they have to come up. I mean, so much of BC was constructed in the 80s, post-Expo housing boom. But the majority of Canadian construction is, kind of the 70s and 80s. And we're just seeing a lot of those components age out. We've got, leaky condos or face-sealed stucco buildings. We've got, windows have changed in terms of manufacturing and installation. And so there's lots of situations where these components, we refer to them as components, have just simply, they've served their useful life, right? And they've done their job, and now it's time to look at replacing them. So they're expensive.
Well, we've all driven by condos and seen those siding projects that have definitely lived their useful life.
Yeah.
And it becomes a matter of timing those projects and funding them. And here we are. You've got your reserve funds, you've got the potential to do a cash call to owners.
Mm-hmm.
And what else?
And so then there's financing, which of course we can drill down on today, which is where the corporation, your business entity, is the borrower, and the corporation borrows monies from us as lender, or whoever the lender is, for the explicit purpose that the owners have permitted the corporation. So $500,000 up to $500,000 for a roof replacement, to be completed in a certain time window. There's usually some basic parameters around what the owners are authorizing. No matter all the way across Canada, the borrowing has to be approved by the owners. So this is another kind of interesting nuance across Canada. In BC, council has no authority to issue a project or a special levy. Just to recap, everywhere else in Canada, for the most part, I'm not a lawyer, so you're always going to want to talk to your lawyer about this, but the broad strokes are that across Canada, a board of directors has the authority to mandate a project and issue a special levy to go with it. And I'm not talking about, putting in hot tubs in everyone's backyard. Let's understand that we're talking about, general use components that have to be replaced, not, vanity projects or add-ons or enhancements. And so in BC, no matter what, the owners are voting, has to pass a 3/4 vote for the project and the funding mechanism. So special levy and financing are subject to that same threshold. Across Canada, if the board of directors wishes to talk to the owners and give them an option on how to pay for the work, they can explain to the owners, hey, we have a $500,000 roof that needs to get done. You tell us, we want to hear from you about whether or not you want to finance this or do it through a special levy. And then there's some way of taking an owner's vote. So it's called different things across Canada, but then essentially an owner vote takes place. If the threshold is passed for financing, the corporation does the financing approach. If the vote fails for financing, then the board can take that as their instruction that the owners would like to be special levied. So there's always, the main point there is there's always owner consent when it comes to financing all the way across Canada.
Excellent.
Yeah.
Okay, so that's how it comes together. I've got some questions about how you release those funds or approve those funds, because Strata can approve a project and they've approved the financing. Do you pay the contractor? Do you pay the Strata? How do you tie those together so that you're sure that the work is being done?
Yeah, absolutely. So after doing this for 20 years, we've got a very refined approach that makes sure there's no room for things to go awry. So our preferred approach is always they're entering into a contract. For a large contract, it's often like a fixed type contract. And then the contractor is invoicing the corporation. So we are not a party to the contract. It's always up to the corporation to enter into their own contract for the work. So contractor invoices $500,000 roof project. Contractor invoices Strata Plan 123. Strata Plan 123 sends the invoice to us and says, please pay. We then have an additional check and balance on that to have two signers, two people that we have identified as legal representation of the corporation, typically council members. It's always a two to sign for us. And they then instruct us to pay the contractor, and that's our approach. I mean, sometimes there can be nuances in it, but the most important thing that usually when I'm talking to boards or councils is they want to make sure that they remain in control of their funds, the same way that if there's a special levy fund, a management company would always get councils or the board's instruction to remit before they release funds. So we follow that same principle.
Absolutely. That makes sense. Great. Let's move on to the next one.
Yeah, so these are just some of the broad strokes. Go ahead if you had a question.
No, I was just going to say we've covered some aspects of this, but this is the process.
This is some of the process. These are just some of the kind of key things that people are curious about when we're having that initial conversation. So the most important thing, I guess, is it's a way for owners to have a choice in how to pay for the project. So it's always subject to an owner vote. What that looks like or what it's called, difference, and what the threshold is varies very much by province to province, varies by any requirements and bylaws, etc. But the most important thing is it's a way for council or the board to get some direction and some feedback, include the owners in the decision about how to pay for a project. At its simplest form, it's an alternative to an upfront special levy. So there might be times when the special levy just isn't the right fit for the ownership for one reason or another. And this is an alternative way to fund a project so that you stay on top of your capital repair cycle. And it's an alternative to doing it through a cash call from your owners. In terms of the owners then usually are immediately curious, well, is this going to affect my mortgage? If I have a first mortgage with ABC Bank, what happens? Are they going to put their finger on the panic button and call me and call my mortgage if all of a sudden we have a loan through the Strata Corporation? So again, legislatively, there's no, and I won't get too much into the specifics of this because this is a game where, getting a legal opinion on these things is always very helpful. But from our perspective, it's not a mortgage product. It's essentially a cash flow loan to the corporation because legislatively, corporations can't pledge common property. So we're not taking a mortgage over anyone's individual units. So if Thomas is the president of Strata Plan 123 and he owns Strata Lot 1, it's not that we're expecting Thomas to pledge his unit. We're not taking any securitization over your unit. We're not interfering with the mortgage you have with Bank ABC. The security is registered against the corporation, and it's not in a mortgage form. So essentially, it's a non-mortgage. We used to just say unsecured, but that's maybe not the right use. It's a non-mortgage product. And from the owner's perspective, there's nothing being registered on Strata Lot 1 for Thomas. We're not registering security on Thomas's credit bureau. I do not want proof of income and a credit bureau on Thomas. And so it's not an individual pledge. The borrower is the corporation. And that is really the most interesting part of how all this financing works, because that's a bit tricky for people to kind of wrap their heads around to understand. And then it makes things quite interesting because then often the question is, well, how do you adjudicate these? How do you decide who gets approved and who's not? And there's a lot of nuance to that, but sometimes in these town halls or these information meetings with owners, someone will put their hand up and they'll say, I'm a commercial banker. what tools do you use to make these decisions? And the reality is, it's not as though the corporation has the typical things that a business would be able to provide, right? So it's not as though they have financial statements showing a consistent for-profit that can debt service a loan amount. It's not as though we can pull a commercial credit bureau. And so taking the time to really understand the legislation and look at other aspects of the deals is how we like to get it done. But from a security perspective, usually the owners just want to make sure it's not going to interfere with their primary mortgage. And that's there's a short answer to that question.
Yeah, it is a real advantage of this alternative, and absolutely, these sort of business loans are not based off of something that will generate income. It's now part of the assets of the corporation that obviously will keep it in good financial and physical health. But your lending has to be based on the cash flow of the corporation rather than any expected business income.
Right.
Very interesting.
Yeah.
So you are cost sharing into the future, though, by not doing the levy today. You're increasing your strata fees or your condo fees to pay this loan back over a period of time.
Right. I mean, that's one approach to get the income coming in on a monthly basis. And so, conceptually, I guess one way to think about it is taking the philosophy of a depreciating asset. So if the roof 20 years ago was expected to last for 20 years, the idea of a reserve fund study or depreciation report is that, okay, corporation, then every month that asset is depreciating and you should be putting an incremental amount into your reserve fund study to be able to pay for that when it needs to get replaced in 20 years. And so it's kind of taking that same concept and just flipping it on the back end, because, hey, like, we can't go back in time. You can't go back in time and put more into your reserve. And so then when the work needs to get done, you guys tell me, how do you want to pay for it? Do you want to do a special levy, or do you want to do it through financing? And then we're cost sharing into the future and taking that concept of a depreciating asset and saving for it and accruing for its replacement and flipping it on the other side of things.
Great. You have a couple of examples. Should we go to those?
Yeah, let's do it. Okay. So this is a little tongue-in-cheek, out with the old and with the flow. So this was a corporation that I worked with. This particular story is based in Alberta. And this corporation was a relatively new construction building. It was only about 15 years old, and they were having some premature failure with their risers and their pipes that were, they were having a lot of water incidents. So they were having, water breaks, which was resulting in floods in people's units, causing a lot of insurance problems, a lot of displacement within the property. And ultimately they had the pipes reviewed, and the expert basically said, recommended a full repiping. So this caught them off guard because they were only, the property was only 15 years old. And this particular material was expected to last for a very long time. So needless to say, this is an example of something that came up unexpectedly. No, it did not. It wasn't scheduled in their reserve fund study because, this was a surprise. So, okay, let's talk about options. This board, it was a masterclass in communication. So let's slow it down. Let's talk with the owners about the project itself. This was a larger complex, so there were multiple buildings. Hey, owners, what do you think? We could do this phased out over each building a year for 4 years. Here's the pricing that the contractors have given us. Here's the pros and the cons of that approach. Main pro being that you're kind of chunking it out into bite-sized amounts. The main con being that, this problem isn't going to go away. That means that last building, who decides who that last building is? And the owners in that last building have to live with this problem for, 3 more years while everyone else gets their pipes replaced. So there was a fairness piece in there that they were really alive to, which I appreciated. And the contractor basically was like, look, we're going to sharpen our pencils and get as aggressive as we can on pricing. If you can commit to us that we can get this all done, then we're only deploying to site once. We only have to get one permit. We only have to have one engineering contract to oversee the work, as versus when you phase it out over time, you kind of lose control over what the costs are going to be into the future. And you're often paying repetitive costs for repetitive pricing. So the example I always give when I'm talking to owners that always gets a bit of a laugh is like the porta potties, right? So these poor trades working on site, unless there's a common room they can access, they often have to set up site services. So, how many times do you want to pay for these poor guys to have somewhere to, wash their hands and use the facilities? You can do that once, or you can do it every year for 4 years and pay for it over and over again. So each project often has these economies of scale, these efficiencies with just getting them done under one project. But what I appreciated about this board was they took the time to just slow it down and talk to the owners about it and broke it down and said, here, we asked the contractor, give us some pricing on what this looks like if we break it out over 4 years. What does this look like if we get it done under one contract? The numbers were very compelling, and kind of the motivation was very compelling to just get it done with. Like the leaks were pervasive in each of the buildings. The problems were known. It was very distressing for the owners, and every legislation has some version of a right to like a peaceful enjoyment of your home, a quiet enjoyment of your home. So there's a lot of disruptions happening. So great, let's talk about it. And the owners were like, yeah, like let's go ahead and get this done under one contract, rip off the Band-Aid. So then we went back to them and said, okay, we heard you on that. Now let's talk about options for how to pay for it. It's going to work out to a special levy of, X dollars, or here's a financing solution where we can get it done under the one contract and spread the payments out over 10 years. It's going to mean a little bit of a change in everyone's monthly payments. And we were very specific about what that was going to look like. And then, you tell us, it's a vote. It's subject to a vote. If the vote passes, we're going to do the financing and it's going to be repaid over 10 years. If the vote fails, no problem. The board's heads up, the board will be issuing a special levy at some point in the next couple months, right?
Wow. And so two things I really want to touch on there. One is great communication. We hear over and over and over again how transparency and good communication really helps.
It's huge.
You mentioned something else too. How does CLG determine the length or the duration of this loan? You said 10 years. Plumbing systems should last 40. Theirs only lasted 15, and that's why they're back to you unexpectedly early.
Right.
Is this their decision, your decision? Do you discuss options?
It's very much a collaborative decision. So something that underpins the repayment length from a basic level is that the repayment time frame should never exceed the expected useful life of the work that's going to be done. So if somebody is replacing fencing that's expected to last 5 to 10 years, then we would say let's tighten the repayment time frame up to something that we know for sure you're going to be done paying this off before you have to do it again, right? But a lot of these new materials and these new components that are on the market now have a very long expected useful life. So that's just one thing that helps us give them some structure and some feedback options on what would make sense for their corporation.
Thank you.
Yeah.
And
so this
how did
was
this
just
project conclude then?
It just wrapped up a couple months ago, and I think everything went very well. So the progress reports were positive. There's always some surprises along the way. So one of the things that also helped with taking the financing approach was they can pass a resolution for an amount that included quite a bit of contingency. So the resolution approved an amount that included a 20 or 25% contingency. And one of the benefits of financing is that you only repay what you borrow. So if you have a $500,000 roof project that includes a 20% contingency, and you only end up needing 475, that's all that gets repaid. So that's how we do things anyways. And so it came in under budget. The board decided to use some of their own reserve monies. In the meantime, they had the reserve fund study updated, because in the owners meeting, they said, well, we have a decent amount in our reserve. Can't we just pay for more of it out of the reserve? And we kind of knew that question was coming. And so the manager and I had suggested to the board, your study isn't due technically for an update for 18 months, but why don't you get an early update, and see how much they recommend you leave as a baseline for right now. You don't want to, my expression is rob Peter to pay Paul, right? You don't want to take everything out of your reserve today and then leave yourself flat-footed for whatever is to come next. So again, this is like everything about this was like a 10 out of 10. The vast majority of projects don't go like this, and they're really bumpy along the way, and boards don't always take the advice or the direction that they're given. But this one was just very successful. So they had an early update to their study done. their reserve fund planner recommended a baseline amount to keep so that they could stay on track for saving for their future projects. And so that allowed the board to make a very, very informed decision about how much of their reserve funds they could pay towards the work. And so that all really came together really well. And I think the board was quite happy with the end, with the work being done. They're all, the contractors cleaned up and off-site. And the hope is that, the owners can go back to some quiet enjoyment of their homes and not dealing with water pouring in through the ceiling and having to be displaced out of their units.
Yeah, that would make it harder to sleep at night for sure. Wondering when the dripping is going to start in your unit. Well, that was a case of someone that was very well organized. Is the next one as smooth, or?
I'm not going to do a horror story. No, this next one is, again, a bit tongue in cheek, rising to the occasion. So the reason I chose these two examples is because they were examples of times where the financing was very well received from the owners. In BC, I always joke that, I spend a lot of my time giving information out and seeing things not come together on the financing side, because it's not always the right fit. And we can talk about that after. I won't take away from talking about this next example, but these are just two examples of where the financing made a lot of sense. So with this one, this was in BC. This was a strata that I worked with. And they had it was an apartment building, and they had just 2 years ago, they had just done a very large building envelope renewal project. And those are quite expensive on a townhouse for sure. But the apartment, depending on the type of cladding on the exterior of an apartment building, they can also get up there in cost. And so these owners had just finished doing a very large building renewal project where they had redone their balconies, new windows, new sliding doors, new building envelope, and it was a material amount per unit between $75,000 and like $100,000 per door, basically, which for an apartment building is a very significant amount for a special levy. Place looked fabulous. It was done. The market had responded in kind. Sales prices were up. Everyone was, happy. Things were good. And they had been on a maintenance schedule. They had 2 elevators. It was high rise downtown. They'd been on a maintenance schedule with their elevators, knowing that elevators needed to get done at some point in the next little bit. And then one of their elevators conked out on them, and just, the service company basically said, we can't, this is a safety issue. We can't, it's grounded. It needs to be redone. So these poor owners, they knew this was coming. They had just contributed a massive amount. They just cut checks for a huge amount of money. And now council is having to go back to them hat in hand to say, we need another $5,000 to $8,000 from everybody for new elevators. Well, this was not, the owners were just like, look, I'm tapped out. Like we just did a 6-figure special levy 18 months ago. I hear you, like no one disagreed the elevator needed to get done. Although they did have a quite serious conversation about whether they could get by with one elevator, which ultimately everybody thankfully came to the conclusion that was not sustainable.
The closer to ground you were, the more acceptable that sounded. But
yeah. So then the manager got in touch with me and said, hey, does this sound like a fit? I said, this sounds exactly like this is in the strike zone for where the owners are going to like this idea. So we have a meeting. Great. Yep. Council's into this idea. Put a resolution out, call an SGM, have a vote. The meeting was done in 15 minutes. The owners were like, yep, let's fix the elevator, finance it, pay it back over, it wasn't a long period of time, 5 or 10 years. I don't remember the exact structure, but, put my fees up a little bit per month and let's get this done. It was the shortest meeting of all time.
If only they were that easy always, right, Kelly?
Which is never the case, right? Like the vast majority of the time, they don't go this way. I highlight these as examples of when the stakeholders who were involved, the manager, council, the contractors, sometimes contractors pass along this information, or reserve fund planners. These are times when the owners like the idea. It's helping them solve a problem, not making decision-making harder or worse. There's a very clear, in each of these examples, there's a very clear rationale why the financing was the right fit. The vast majority of the time, that's not the case. When people call me, I usually, spend a lot of time trying to understand what's the situation, what's the problem, where's it bottlenecking. Let's talk about options. Because I don't want council or the board to lose control over the conversation about the project. I will reiterate, my most important slide was slide number 1, which is stay on top of your capital repair cycle. Keep the financing as an option for when you need it, but it's not the be all end all. It's not a solution if the owners are not bought into the work. If the owners don't think the work needs to happen or they're not engaged with it, financing is not going to help anything. Where financing helps solve a problem is when there's work that needs to get done and there's a reason why the special levy isn't the right fit for that particular project.
And let's talk about some of the kind of practicalities of this, Kelly. Rates move constantly, so we're not going to talk numbers, but in terms of financing cost, tell us a bit about where a CLG condo loan might land.
Yeah. So the general rule of thumb, and this connects back to the security piece, is, for example, if we talk about the apartment building, if they had have called me 2 years ago and said, hey, can we talk about financing for a building envelope project? It's going to be $75,000 to $100,000 per unit. To me, my best advice to that corporation is that's a really great thing to talk to your owners about doing a special levy. Because if you put yourself in the position of an owner, which I always do, there's more financially efficient ways for me to fundraise $100,000, which is doing refinancing my mortgage or doing a home equity line of credit. Those are the two most, from a bank's perspective, secure forms of lending that are out there. So because they're the most inherently secure, you're going to get kind of the lowest interest rate because there's no risk-based pricing there. So we'll just refer to mortgage rates as personal secured mortgage rates, first mortgage rates. And then if you look at where the strata financing or the condo financing rates fit in, there's going to be a bit of a premium on that because, again, let's remember we're talking about lending to a nonprofit entity with no security to pledge. So there's going to be a bit of a premium on the rate. In my experience, people know it's going to be a little bit higher than a mortgage rate, but we're not talking 10%, 15%. There's going to be a little bit of a lift, but it's not as bad as people are expecting. And then if you compare that to basically any other type of lending that's out there, like if the owners do a special levy and they want to get a loan for it, if they do not want to touch their mortgage, I think, again, if I put myself in an owner's shoes, it's going to have to be a pretty large amount of money for me to go to my bank and renegotiate my mortgage and do an equity takeout and break my rate potentially. And that's not a simple thing to do. It can be done. For 6 figures, I would. For 5,000, no. I'm going to look for other ways to come up with that money. So if I'm looking for $5,000 and I don't have it in cash, I might consider a general personal loan without pledging any security. I might consider an unsecured line of credit. And so those are going to come higher than us. Those rates are going to be higher than a strata condo loan. So recap is cheapest money in the market, a secured first personal mortgage, someone with good credit. We're a bit above that. And then above us is going to be basically any other type of unsecured personal lending.
Excellent. So if you've got a community where there are people who are just not in a position to refinance their mortgage, or they've been hit with repeat levies and they just can't stare down another one, that's where this becomes a really compelling alternative.
Right. And, I think it's a function also of what's the dollar amount per unit? People will often ask me if I'm doing an education session, well, what are your limits around how much you can and can't lend? And I say, look, a $250,000 project might be $2,000 per unit to a large building, and they may not care about that delta in the interest rate. It's going to be like $1 a month difference to them if you break it down. But if you're talking about a 12 unit, one of these little 12 unit apartment buildings, that's more material on a per unit basis. So looking at the per unit is really a key driver. And for natural and intuitive reasons, the larger the amount per unit, the stronger the feeling about how people want to come up with their share of that money.
True. I mean, that does also mean that potentially hundreds of people have to go out there and sort out their own financing, which is not an insignificant undertaking. So there's got to be some trade-off in their thinking around that as well.
Yeah, and that's where just slowing things down and explaining things. That's, you know, the education piece is paramount to me. It's huge.
Great. You've talked about the sorts of projects that you've funded. Is there any sort of typical item that you see? Is it roof? Is it envelope? Is it elevator? What is there a typical thing, or is that not?
Not really. You know, right now roofing is hot because we've already had some big downpours, and people who were kind of putting off their roofing projects are now really faced with not the right decision any longer. So like a lot of roofing right now, repiping, windows, do a lot of windows. Those are probably the three main that I like just in the last little bit, but you know, HVAC, we can do like like any type of common property or shared component. And then depending on where the corporation is across Canada, looking at some of those larger projects like building envelope work, sometimes it's a fit and sometimes it's not, for a variety of reasons that I'm always happy to have one-on-one conversations with clients about. But yeah, like a lot of roofing, a lot of repiping, a lot of underground work right now, like parkade slab, that type of thing. Hard
Not a
landscaping
lot of
often
vanity
goes with
projects
that.
here. This is not a hot tub loan.
No.
Glad to hear it, actually. You mentioned that there wasn't security. Is there anything that a condo can do in any of our provinces across Canada to get a better rate? Can they do anything if they have a strata suite, or is there anything they can do to help their rates?
Yeah, you know, sometimes they'll call and they'll say, hey, you know, we have this big project we have to do. We own a caretaker suite, like, so understanding again the different for the council of the board to understand what's real property. So legislatively, real property is usually referred to like an actual asset that they own. So like a caretaker suite, or, you know, some of these buildings in the downtown city centers have one, two, three rental suites that they own in Airbnb, or people can rent them out for when friends and family come. Those are typically, again, talk to your lawyer, those are typically considered like actual real property of the corporation and can be mortgaged. It gets it's still a bit tricky to do them that way. And in my experience, Thomas, there's still usually a big gap in the number. So if they have a little caretaker, a little one bedroom, because these are the small units, it's the little studios or one bedroom apartments that are caretaker suites. And maybe it's worth a couple $100,000. Well, that's great. But if you need $2 million for a repiping project, we're still kind of, you know, where there isn't a lot of tangible, touchable security.
Excellent. Thank you for clarifying that. Loan structure, are these typically fixed rate, variable rate? What does that look
Yeah.
like?
Yep. So it becomes a set it and forget it once the loan converts to the term debt. So it is fixed. It's fixed when it's on the back end of the deal.
Great. Good to know.
Mm-hmm.
Penalties for early repayment if they were in such a position for some reason?
Yeah. If somebody, you know, wins the lottery.
Yeah. I mean, do they all
And
win the lottery? Is this a
someone gets a cash windfall and cuts a check to the corporation. So there's usually an annual prepayment amount, and then at the end of the term, if the amortization exceeds the term, then at the end of the term they can pay down as much as they would like, pay it off, refinance. So there's lots of flexibility, lots of off ramps along the way.
Excellent. We didn't go into the weeds in this discussion, but at a very high level, do you work with engineering firms or project managers to estimate realistic costs and funding needs?
Yeah, absolutely. So we become part of the project team, because we want to make sure that we're all looking at the project from different angles. So I'm a big believer in staying in my lane. I'm not an engineer.
Seem to have lost Kelly for a moment. See if she reconnects. Well, I'm going to continue where she froze and indicate that they do stay in their lane, as she's suggesting, and thus they would defer to the experts who are in a position to make the best estimates and outcomes, and that's why they would collaborate with all of the stakeholders, whether there be a property manager or the strata council or the engineering firm. I think there's a lot more that I wanted to ask Kelly, and I know that some of you have had questions on this subject as well. She may reconnect with us, and if she does, then that would be great. But otherwise, I think I'll just recap a few of the things that we talked about today. So one of them was relating to the amount of funding that's required for capital projects across this country, the fact that there are numerous different mechanisms to fund them, and that lending may fit in as a piece of the puzzle for your funding for a condo corporation or a strata across Canada. What I will do, since she's no longer with us, is throw up the QR code so that you can see where to reach Condominium Lending Group. There is a QR code that you can scan, or you can go to condolending.com to see a bit more about that. Otherwise, I was just going to wrap by saying thank you to Kelly for sharing her expertise. Do go to condolending.com to ask her any questions. And next week, we'll return with Ryan Grant, Property Flute, to discuss reimagining general meetings. Thanks, everyone, for joining us, and we'll see you again next